What's up, you guys? Michael here. Let's talk about Roth IRAs. In this video, we're going to discuss what a Roth IRA really is, when it came into existence and why, and what factors you should consider before investing in one, and of course, how you can become a Roth IRA millionaire. Now, if you guys are willing to help a little YouTuber like myself out grow my channel, it goes a long way. Just hitting the like button below. Honestly, I can use all the blessings I can get from the almighty YouTube gods. So for that, I thank you. So first, let's just define what an IRA is. Now, IRA stands for Individual Retirement Account, and the traditional IRA was put into place by government in 1974. And this was put into place to allow individuals to put tax-free or pre-tax dollars rather into a retirement account which you can self-direct where that money is invested. Now, this allows individuals to contribute to a retirement account and also reduce their taxable income every year because this is pre-tax dollars that are invested. Now, people often refer to this as letting your money grow tax-free, and while it grows tax-free, don't let that fool you. It's kind of a play on words because you will have to pay taxes on that when you make withdrawals in retirement. Fast forward to 1997, where the Roth IRA was introduced and named after Senator William Roth. Now, this was part of the Taxpayer Relief Act. Now, the Roth IRA is funded with after-tax dollars and is intended to help you save for retirement while also not decreasing the amount of tax dollars the government collects. So to further clarify, the difference between a traditional IRA and a Roth IRA is just when you pay taxes on that income. With a traditional IRA, you're deferring those income taxes until you withdraw the money at retirement, whereas a Roth IRA, you are paying whatever marginal tax rate you are obligated to pay in the year that you invest that money, and then when retirement comes around, the withdrawals are tax-free. So regardless which option you go with, Uncle Sam's still gonna come knocking. It's just when you wanna pay taxes. So let's review a few key things that you need to consider before choosing whether you want to invest your money in a Roth IRA. Now, number one is your age. If you are younger and not currently making as much money as you plan to earn later on in life, it probably makes sense to consider a Roth IRA because you're gonna have a lower marginal tax rate today, so you can go ahead and pay those taxes and likely pay less on that income than you would come retirement. So this will allow you to pay less in taxes over the course of your lifetime. Point number two to consider, now if you're in a traditional IRA, and this is similar to that of investing in a traditional 401k, if you take a withdrawal from your retirement account before the age of 59 and a half, you are most likely going to be subject to a 10% penalty, and you'll have to pay income taxes on it when you make that withdrawal. Now, there are a few exceptions to that rule. Now, with a Roth IRA, on the other hand, you can actually dodge the tax and 10% penalty as long as you take withdrawals from the contributions that you put in, not the earnings from those contributions. Now, this is something to consider because if you ever have to access your retirement funds for use of emergency, then it probably makes sense to have a Roth IRA set up because you can take those withdrawals penalty-free. Point number three to make, traditional IRAs are subject to RMDs, or in other words, required minimum distributions, which start at age 72. So you actually have to begin withdrawing money at a specific age because Uncle Sam's coming knocking. Remember, they have to collect their money at some point and you can't defer it forever. So they require you to take those distributions at a certain age. Now, if you do not take that required minimum distribution, then the IRS could hit you with upwards of a 50% tax penalty for not withdrawing that money on time. Now, with the Roth IRA, on the other hand, since you've already paid income taxes on that money, you are not required to take required minimum distributions. So you can actually let that money sit and grow even longer if you'd like without facing potential penalties. Point number four, and this is kind of interesting, the contribution limit, at least in 2020 and in 2021 for both traditional and Roth IRAs, is $6,000 per year. So if you guys are able to max out a traditional or a Roth IRA or a combination of the two, just keep this in mind. If the maximum amount you are allowed to contribute is $6,000 for a traditional, just remember that's pre-tax dollars, so that $6,000 is not all your money. On the other hand, with the Roth IRA, you're able to contribute $6,000 post-tax dollars that can grow tax-free, that money is going to be worth more come retirement. Point number 5, and this is something really interesting to consider, and it's something that's really out of our hands because we cannot predict the future. And that is, what are the marginal tax rates today and what will they be when you guys actually retire? So believe it or not, we are actually among the lowest marginal tax rates at a federal level that we've been throughout US history. It's not the lowest ever, but it's among the lowest. Now, why do I mention this? Regardless what side of the political spectrum you're on, we have to understand that with a growing government, and we have government programs that are likely going to be implemented, with those programs, they're going to have to increase taxes. It may start with ultra wealthy people, but eventually they're going to have to bump up marginal tax rates across the board to be able to fund these programs. So regardless if you guys are for socialized medicine or not, or free college education or not, it doesn't really matter to me in this book. We just need to think about it from an investment perspective. Now, if you guys believe those programs are likely going to be implemented and exist for many years to come, you should prepare to pay a higher marginal tax rate later down the road. So when you consider this, consider investing in a Roth IRA because you get rid of that tax liability up front and let it grow truly tax-free so you don't have to worry about taxes being higher when you're actually making those withdrawals. So how can you become a Roth IRA millionaire and how long will it take? That's the ultimate question. So just for example's sake, let's just assume that your investments will compound annually at an average rate of 8%. Now currently the maximum amount the government allows you to contribute to your Roth IRA is $6,000. Now this will change in years to come. Oftentimes every 3 to 4 years the government changes the maximum amount to adjust for inflation and things like that. So expect it to creep up to $6,500, maybe $7,000 and $10,000 and beyond throughout your lifetime. But for this example, we're going to assume that we max out that $6,000 contribution and it remains constant over time. So if you're investing $6,000 per year, that comes out to an average of $500 invested each month. So let's assume you start with $0 and you're going to invest $500 per month. And we can go online and look at any compound interest calculator to see how these numbers stack up. So in this case, it would take you 34 years to become a Roth IRA millionaire and grow your money to $1,027,900.82. And remember, you already paid taxes on this, so this money is tax-free come retirement when you take withdrawals 34 plus years from now. So that's amazing. As long as you are consistent with your contributions. And honestly, this could be much higher because if you consider the fact that the government's going to likely raise this limit every few years, you can actually contribute more than $6,000. Now, here's another thing. If you're 50 years or older, they allow what's called catch-up contributions, which is going to be $7,000 today. So typically later on in life, you're actually able to contribute even more. So just keep that in mind. So as you continue to invest over time, that sum of money can actually compound even greater if you're able to contribute more. Now listen to this, because this is where compound interest just becomes insane to consider. Now, if you were to start investing earlier at even a younger age and allow your money to grow for several more years beyond that 34-year mark, how much money do you think that would grow? So what we're going to do is look at the same example, but instead of 34 years, we're going to look at 40 years. So just $6,000 every year for an additional 6 years. So at the end of 40 years, that money will now be worth $1,678,686.24. Now in those 6 years, that's a 63% increase in your money just by letting it compound for an extra 6 years and contributing that $6,000 continuously over those years. So that is the true power of compound interest. And you guys need to understand that, especially for the younger folks watching. The sooner you start investing, regardless if it's a Roth IRA, if it's real estate, if it's the stock market, 401k, all those things are powerful tools to make sure you grow your wealth long term. So the sooner you start, the longer you have to compound and grow your nest egg. Hopefully you guys found a little bit of value and I sparked your interest in investing in a Roth IRA, or at least considering it as part of your retirement plan. It doesn't have to be the sole method of investing. I actually encourage you guys to invest in other things. Of course, if you're subscribed, you know that I'm a big proponent of investing in real estate and letting your money grow there as well, in addition to the stock market and IRAs and things like that. So if you guys haven't subscribed but found some value from this video and would like to see future content similar, please do subscribe below. Again, like and comment. I love interacting with all you guys. Drop your questions. Let me know what you're invested in. I'd love to learn what you guys are doing. So thank you guys so much for taking the time to watch this video today, and I hope to see you again soon.